Good afternoon, students. Today we discuss about 11th accountancy afternoon video. In this video we start a new chapter, that is capital and revenue transactions. Lesson number 11, capital and revenue transactions. So first we discuss about the various terms of capital and revenue transactions. Nature of business. Say expenditure on purchase of goods is revenue expenditure. Expenditure on purchase of asset is capital expenditure. That is, whatever the expense spend in order to make a revenue, that expense is called as revenue expenditure. And in order to spend any amount to purchase an asset, it is capital expenditure. So depends upon the nature of expenses, we can divide whether revenue expenditure or capital expenditure. And then effect on revenue generating capacity of business. If expenditure helps to generate income or revenue in the current accounting period, it is revenue expenditure. So whatever the amount spent for current year in order to make revenue or income to the business, that expense is called as revenue expenditures. Purpose of expenditure. If expenditure is incurred in the normal course of maintenance of an asset, it is also revenue expenditures. So in order to maintain the asset in working condition, that expense is also called as revenue expenditure. Then materiality of the amount involved. So relative proportion of the amount involved in considering in distinguishing between revenue expenditure and capital expenditure. If the amount of expenditure is material, it is treated as capital expenditure, even if the expenditure does not increase the production capacity of the asset. So any amount spent in order to use the spare parts of the machinery, that expense is called as a capital expenditure. Or if the amount is spent in order to expand the building, additional rooms or any other fixed point of view, it is also called as capital expenditure. Then classification of expenditure. There are three types of expenditure: capital expenditure, revenue expenditure, and deferred revenue expenditure. Capital expenditure means it is an expenditure incurred during an accounting period. The benefit of is available for more than one accounting period. So that type of expenditure is called as capital expenditure. Whenever we spend amount during the accounting period, but the benefit will be arrived more than number of years, so that type of expense is called as capital expenditure. Features of capital expenditure means it gives benefit for more than one accounting period, and it includes acquisition of fixed assets and all expenditure incurred up to the asset is ready for use. It contributes to the revenue earning capacity of the business. That is, if we spend amount, means it will help to increase the earning capacity of the business. And it is a non-recurring in nature, because of the capital expenditure will never regularly spend. So it is a non-recurring in nature. It is shown in the asset side of the balance sheet. Examples is cost of acquisition of land and building, cost of acquisition of office equipment, computer and air conditioner, cost of acquisition of plant and machinery, including installation charges. Then revenue expenditure. Revenue expenditure is day-to-day expenditure. In order to spend any amount to maintain the business or regularly spend some expenses in the business, that expense is called as a revenue expenditure. In order to increase the earning capacity and in order to maintain the earning capacity, if any amount is spent, means that amount is called as revenue expenditure. It is recurring in nature because of we are spending regularly the expense, and the revenue expenditure be incurred in relation with the revenue or in relation with a particular accounting period. Features of revenue expenditure is it is a recurring in nature, and it is incurred for maintaining the earning capacity of the business. Its benefit expires in the same accounting period. If you spend some amount for revenue nature means that the benefit will be arrived in the relevant year itself. It is shown in the debit side of the profit and loss account and trading account. That is purchase of goods for sale, administrative expenses, selling, distribution expense, manufacturing expense, everything will be the revenue expenditure. And deferred revenue expenditure, an expenditure which is revenue expenditure in nature, but the benefit which is to be derived over a subsequent period or periods, and it is known as deferred revenue expenditure. Even though the expense will be a revenue nature, a recurring nature, but the benefit will be derived over number of years like capital expenditure. So it is called as a revenue expenditure. It is for the time being deferred from being charged against income. So it is charged against income over a period of certain years. Features of deferred revenue expenditure. It is a revenue expenditure, the benefit of which is to be derived over a subsequent periods or periods, and it is not fully written off in the year of actual expenditure. It is written off over a period of certain years. So whatever the amount spent for deferred revenue expenditure, that amount will be written off several years from the profit arise in the business. The balance available after writing off actual expenditure minus amount written off is to be shown in the asset side of balance sheet, because of it is carry forward several years. Example for deferred revenue expenditure is considerable amount spent on advertising and major repair on plant and machinery. Comparison of capital, revenue and deferred expenditure. Naturally point of view, it is non-recurring in nature, capital expenditure. Revenue, it is recurring in nature. Deferred, it is non-recurring in nature. Purpose, in order to capital expenditure to contribute to revenue earning capacity of the business. Revenue expenditure point of view, to carry on the day-to-day activities of the business. But deferred revenue expenditure point of view, to get benefit for certain years. Period of benefit, over a long period. In the case of capital expenditure, benefit will be available for long period. But revenue expenditure, only the current period itself we can have benefit. In the case of deferred, several years, more than 1 year we have some benefit while incurring deferred revenue expenditure. And then the effect on profit earning, it increase the profit earning capacity of the business for capital expenditure. And revenue expenditure point of view, it maintain the profit earning capacity of the business. And deferred revenue, it is of benefit to the business for certain years. Accounting treatment, it will appear in the asset side of balance sheet, but the revenue expenditure, it will appear in the debit side of trading and profit loss account for current year only, and the amount written off during the year is shown in the debit side of profit loss account, and the remaining amount will be shown in the asset side of balance sheet in case of a deferred revenue expenditure. Then capital receipt. Capital receipt means receipt which is not revenue in nature is called a capital receipt. It is non-recurring in nature, and the amount received is normally substantial, and it will be shown in the liability side of balance sheet. Example for capital receipt will be proceeds from issue of shares and debentures, long-term loan raised from bank and other finance institutions, proceeds of sale of fixed assets, proceeds of sale of long-term investments, receipts of special donation. These are some of the examples for capital receipts. Revenue receipt means receipts which are obtained in the normal course of the business is called as revenue receipts. It is recurring in nature. This amount will be received generally small amount in the business concern. Example of revenue receipt will be proceeds of sale and interest on investment received, rent received, dividend, commission earned, etc. and also discount received. And these are some of the example of revenue receipts. There are some distinction between capital receipt and revenue receipt. Naturally, capital receipt is non-recurring in nature. Revenue receipt will be a recurring in nature. Size amount is generally substantial, that is large in the case of capital receipt. In the case of revenue receipt, amount is generally small. Distribution, these amounts are not available for distribution as profit. But revenue receipt, it will be excess of revenue receipt over the revenue expenses can be distribution of profit. So students, with that we conclude this video session. You can go through all the points which are taught in this video lesson. Write all the answers in your commerce assignment notebook, accounts assignment notebook, and send a task complete message in the group between 6 p.m. to 9 p.m. today itself without fail. Thank you.